Hey, everybody. It's Dugan Kelly with Kelly Clark Law. Thank you for stopping by. We are going to talk about my favorite part of the tax code today, and that is Section 1031, and in particular, why multifamily syndicators and passive investors should care about 1031 and how you allow a 1031 party to participate alongside of a syndicated entity in connection with the acquisition of a piece of property. So what you're going to learn today, and we're going to cram a lot of material and information into a very short period of time. So this is meant to be a high level overview of this process. Is what is a 1031 exchange? What are the easy rules for 1031s? Why are 1031s so stressful for most people? And then what's the secret sauce? How do you 1031 into a syndication? And what's this thing that I've heard called a TIC? And what if I need to bring debt too, if I'm the 1031 party? So, and then what happens on exit? And then the basically an overall view of 1031s. A little bit about myself. For those of you that don't know me, I'm a full-time real estate and commercial securities lawyer, licensed in multiple states. We have offices in California and Dallas, Fort Worth, but most of our clients are buying and selling properties all around the country. We've represented deals in excess of several $billion. On average, we syndicate for clients deals around 400 million or more per year. And then we also litigate in the event that there are issues that pop up in connection with your particular property. So what is a 1031 exchange, right? You've heard me say at the top, this is my favorite part of the tax code. This is the section of the Internal Revenue Code section. It's section 1031. It enables a taxpayer to sell an investment property with little or no tax liability on any resulting gain, preserving the sale proceeds for the purchase of another investment property. So buy low, sell high, have a gain, want to avoid paying taxes on it. 1031 is the section of the Internal Revenue Code that allows you to have basically a wealth building loophole to help real estate investors and syndicators, those of you that are watching this right now, to continue an investment without any adverse tax consequences. This is tax deferred, not tax free. So for many, many years, there were lots of people that said, hey, you cannot 1031 into a property alongside of a syndication. That's not true. So I'm going to teach you through this that you can. But this is not tax free. This is tax deferred. So the 1031 allows you to defer that paying the taxes on that gain from the sale of that relinquished property throughout your life if you continue to do it. And then when you pass away, your heirs will get what we call a step up in basis, meaning if you had a gain of this amount of money, your heirs will essentially assume your position in that property and not have to pay capital gains tax on that. There's no limit on how many times you can do this. I have clients that have done this literally for decades, been able to 1031 and not have to pay taxes. This is a legal, not an illegal. This is a legal way to tax defer those gains. All right, here are the easy rules. All right, one, all cash proceeds from the sale of the relinquished property must be reinvested in the replacement property. Or guess what? You're going to have to pay the taxes on the difference. Two, the purchase price for the replacement property must be at least as much as the sales price of the relinquished property, or you got to pay the taxes on the difference. Three, the purchaser of the replacement property must be the same as the seller of the relinquished property, or be what we call a disregarded entity. This is an important one for those of you out there that currently own commercial investment properties or in your own individual name, but you would like to own the replacement property in an LLC. An LLC is treated as a disregarded entity. So the IRS really looks at who is the taxpayer of the sale of the relinquished property, the property we sold that resulted in that gain that we're trying to defer those taxes on. Who's the taxpayer? And a disregarded entity is a pass-through entity. It's one in which the IRS says they will look to the ultimate owners of that entity. And so you can sell a property in your own individual name, take ownership of the replacement property in an LLC that you also own, and it still be 1031 compliant. For safe harbor protection, that means not paying taxes. We are safe from having to pay taxes. All of the gain, the funds, must go through what is called a qualified intermediary. These are specialized individuals or companies that are assigned before you sell. So the time to hire the qualified intermediary is not at the time in which you're about to get the money. It's at the time that you're thinking about marketing and selling that property that's going to result in the gain. You want to have your qualified intermediary participating with you. They take possession of those funds so you don't, so you have safe harbor and don't have to pay the taxes on it. And then 5, you have to purchase in the replacement property. You have to use those funds. You can't just let them sit there. You have to use those funds for the purchase of a replacement property. That replacement property, the IRS says, it must be one that is like kind and that it is intended to be held for rental, investment, or use in a business. So what are like kind, right? We've all heard that. If I own an Airbnb, does that mean I have to go buy another Airbnb? No, you can go Airbnb to single family, Airbnb to multifamily, Airbnb to commercial office, or vice versa. These are all of the areas in which like kind, the IRS says these are like kind types of property. And you can see that is a very broad definition. So you don't have to buy apples to apples, but you do have to stay in real estate and you do have to use those properties for an investment. All right, what's the timeline? Well, the timeline is really tight. It's 180 days. So from day one, the day that you sell your property, you have 45 days to identify other replacement properties and then 180 days to close. That deadline is not movable. It is rigid. So don't delay. You've got to complete your entire transaction inside of that 180 days. All right, 1031s are obviously, they can be stressful, particularly if you're not participating alongside seasoned other operators or syndicators. So you're trying to find properties that pencil out. Maybe you live in a market that it just isn't conducive, and that's the market that you think that you have to buy in. Working with banks to qualify for loans, even if they're recourse loans, is not always easy. And then there's a catch-22, right? Buying value-add properties. That takes time, resources, money. Maybe I have a full-time job. For most people that have 1031 money to deploy, they are working full-time. They're not professional real estate investors. And so there's just a lot of stress dealing with that. But if you do what we're talking about here, this possible scenario, and that is being able to invest alongside of a syndicated entity, there are benefits, and it increases your buying power, meaning you're able to invest in a much larger asset, being able to scale and leverage up into an apartment building from maybe that Airbnb or that single family residential home that you're renting out. It's a passive investment, maybe potentially, because you have now professional property managers or asset managers that will be able to manage it for you. You can get into other markets, hotter markets than maybe where you live, and be able to not have to be an expert in that market. You might not necessarily have to qualify for financing because now you're able to do a non-recourse loan, in which case the lenders are underwriting the financial performance of the property and not you individually, which is a very key distinction between recourse and non-recourse debt and assets. And then all this automatically decreases the risk and stress of the 1031 process by being able to participate alongside of a seasoned operator. This is the typical deal structure that many of you are accustomed to if you've invested in a syndication, where you'll have a new LLC created. There will be a split of ownership in that same LLC between passive investors and the operators, the sponsors, the syndicators. Those terms are often used interchangeably. Well, let's look at what the new structure will look like. This is the secret sauce. The new structure is going to involve what we call a TIC, or tenants in common. This has been around for hundreds of years. This is not new. This has been around, which allows basically multiple property owners to own the same piece of real property. The key is you own an undivided interest in that real property. So let's look at theoretically what that overall structure looks like. This is the new structure. So remember, just a few minutes ago, there was the other structure, which is the typical syndication structure, where you have passive investors on one side and you have the sponsors, people putting the deal together on the other side, and you have basically both of those groups owning pieces of an LLC. Well, in this scenario, we have basically three owners. We have two parties, Tinker and Taylor, who are our 1031 parties, and they will own collectively between them 8% undivided interest in the same real property. Whereas the syndicated entity, the entity with passive investors and the sponsors, will own essentially 92% of undivided interest in the same real property. But yet the asset manager, the day-to-day manager that the bank will likely approve, is the same sponsor, meaning the same operators that under the old scenario will likely be the same asset manager under this scenario. This is how 1031 parties can participate alongside of a syndicated entity and acquire an undivided interest in the real property. In this scenario, the sponsors or the operators, the syndicators, allow the 1031 party to purchase directly from the seller of the real property an undivided interest. So it is as if multiple parties approached the same seller and said, hey, what will you sell for 5% of your property, right? Ultimately, the borrowers, the owners will own 100%, but they are essentially engaging in real estate transactions by themselves with the same seller. And this is how they participate. How do they participate with one another? Well, they do so through a TIC agreement, meaning the sponsors and operators will have their syndicated entity with an operating agreement that will set forth the rights and responsibilities to the passive investors and to the sponsors in that syndicated entity. On the other side, we have Tinker and Taylor, right? Our 1031 parties. Well, they will participate with the syndicated entity through a co-ownership agreement or a TIC agreement. These agreements are often required by the lender. You should have something in writing. They will define essentially how the co-owners participate and who's going to be essentially in control of certain decisions, what the annual budget is going to be, who the property manager is going to be, when our distribution is going to be, what are the voting rights. All of these various things are set forth in this TIC agreement, which often mirrors what an operating agreement in another LLC might look like, or a shareholder agreement in a corporation, or a limited partnership agreement in a limited partnership entity. So this is the legally governing document that often exists between all of the owners that own those undivided interests in the same real property. Voting rights in this type of structure are spelled out according to the terms in the TIC agreement. In most cases, the 1031 parties vote on a few items, and they have the ability, the legal right to vote on these things, like hiring a new asset manager, maybe the approval of an annual budget, a decision to finance or refinance, funding of deficiencies, meaning capital calls and so forth, or the transfer of the TIC owner's interest. Remember, the lender is the biggest investor in every transaction in which you theoretically have debt on. So that means that all of these rights will ultimately have to be looked at by the lender and blessed by the lender throughout this process. What happens if you need to bring debt if you're the 1031 party? That's not a problem. Because remember, we're scaling up into a larger asset class. Even in the non-recourse debt phase, many lenders will allow you to bifurcate the loan, or you will be allocated some of the debt associated with that, or you will be a joint liable person on those carve-outs, meaning the non-recourse debt aspect of that asset. So your actual share of the project, the way that your undivided interest in the real project is often calculated is based upon what cash you bring, though. So if you have a lot of debt and not a lot of cash, don't expect to get a large undivided interest in the real property unless the other co-owners agree on that. The lender is often going to have to underwrite you. So remember this, if you're a 1031 party, don't expect to not have to sign loan documents, even in non-recourse loans. You're likely, or your entity, if you've created a disregarded entity for that transaction, that acquisition, is going to have to sign on the loan, just like the syndicated entity. So if you have bankruptcy or some sort of ongoing litigation thing that might be a disqualifying factor, share that up front. Be truthful, be honest, be transparent. And many lenders will be able to work with you around any particular issues that arise. All right, there are lots of paperwork that comes in all these transactions, and the TIC parties, including the 1031 parties, are likely going to have to sign all these things, from the co-ownership agreement to potentially an asset management agreement to a limited power of attorney for certain things that the bank or the lender is requiring a day-to-day manager of all of the TIC borrowers. All of those things you'll have to be signed into the process. What are the costs? Are there any costs? Well, yes, of course there's costs. Just like any type of real estate transaction, there's going to be costs associated with the transaction. But typically, most of those costs get paid out at closing through the loan proceeds or the equity that you bring to the table. What happens on exit? Do you have to do the exact same thing as a syndicated entity? No, you don't. So if you're a 1031 party or you're a sponsor syndicator and you're thinking about, okay, should I allow the 1031 party to purchase from the seller an undivided interest, and will that jam me up with my passive investors? The answer is no, it won't. So many syndicators, they take their money on exit, they distribute those back to passive investors, and everybody pays their taxes. If the 1031 party doesn't want to do that, they just simply move on to another deal, start the clock over again, that 180-day clock, and go into another transaction. What happens at a refinance? Many refinances and the money that gets pulled out are non-taxable. You should always check with your CPA regarding every refinance, but in many cases, the refinance proceeds are not taxable. I know that's a lot of information that we just imparted to you. We just told you some of the secret things that many people that are smart about syndicating and allowing 1031 parties to syndicate or to invest alongside of them in the same transaction. Many of you may have not even heard of this. And this is a great opportunity for you to think about getting more involved in controlling your financial future. Here's our information. You can check us out. We're on Instagram, Facebook. We have a YouTube channel, our locations. There's our telephone number, my email address. I'm happy to chat with any of you about your particular situation. And hopefully this has been a helpful short video.